Starting with crude then, and the Brent is trading at $111 a barrel today, which is a two-month low for the commodity. The crude prices have declined 5.6% for the month of Feb alone, as investors remain worried about the slowdown in China, the weakness in Eurozone, and also the automatic spending cuts that kick in tonight in the United States. Take a look at the gold prices as well, which is on track to log a third straight week of losses as a strong dollar and waning investor interest weighs onto the sentiment. Some physical buying from Asia is lending some support to the prices, but gold also has declined 5% in month of Feb. The ETF holding has declined for a 7th straight session. Silver price is also down 9.3% for the month of Feb, and March has started on a weaker note for the precious metals as well. Let's get in our guests then, and joining me in the studios is Shamik Bose, Executive Director, Commodity and Currency, Microsec Commerce. Also joining is Vijay Bambwani, author and CEO at bsplindia.com. Mr. Bose, hi, let's start with you first. And the kind of decline that we have seen in the precious metals, the March also starting on a weaker note, how much of a further decline are you expecting?
Well, Manisha, last time it had turned from 1550 for gold and around about here for silver. I expect this technically to go towards 1520. If it turns from there, it makes a triple bottom. But looking at the technical price reaction, I see two things. One, the market is getting oversold on a weekly basis, and secondly, it might go down below 1520 this time. Now, whether it will be a decoy move or not, I do not know. But fundamentally, gold seems strong. Technically, gold seems weak. The two things are diverging quite a bit. The prolonged consolidation period since we saw $1,920 in 2011 and $49 for silver have continued. Usually these last for 16 to 18 months, but now we've exceeded that frame. And as far as I see, the markets are getting a little oversold. Technically, the markets are very weak technically. Fundamentally, it's a good place to buy, and fundamentally the problems which caused gold silver to go up in the financial debasement scenario and safe haven buying have not got anywhere. They've moved off the front pages, but they're still there. There's a lot of tension, there's a lot of fundamental demand for gold and silver, and I personally think that this stories of ETF sell-offs are exaggerated. If you see the overall ETF holdings, they're still firm. Central bank buying is going on. So I'm looking at these places as a way to buy, providing you're diversifying as an investor. If you're a speculator, markets are getting oversold.
Vijay, what's your sense coming in for silver now? 1.5% of decline in the international markets today, and same is the case with the Indian markets as well.
Manisha, I would agree with Mr. Bose here that markets are basically looking a little oversold on the charts. But sentiments for gold and silver both have remained subdued. That's one reason why I've advocated a hands-off approach in the leverage space. I would continue to stay off the leverage space, whether the markets look oversold or otherwise, because this kind of an oversold reading is known to be persistent on the charts for a while, and markets can basically slide over protracted periods of time on very thin volumes and stay oversold. But the delivery game is a different ball game altogether. I'm seeing gold in the 5th March ending expiry series at 52,800 odd levels. So if that price slides by another 500 to 700 rupees, so say 52,000 rupees, and if I was to get silver close to that price, plus VAT of course, in the physical delivery market, I don't really mind sinking my teeth into some more deliveries. I don't mind allocating further 10% to silver at 52,000 in the delivery segment, plus 1% plus VAT. So I would enhance my exposure to physical delivery in silver. If you give me sub 50,000 levels plus VAT, I would sink my teeth another 20% into that physical investment of silver.
Let's get an industry view as well, and joining us from Delhi is Mayank Khemka. He's MD from Mayank Khemka Group of Companies, and he joins us live. Mayank, hi, welcome. You heard our experts. They are slightly bearish for the near term in gold and silver, both these. And let's start with the budget first, though, because we haven't heard anything in sense of curbing any more imports. Markets were expecting some more steps to be taken. That hasn't come in. How are you reading all of that?
I think the announcement which was supposed to come with the budget came 2 months before. So on 21st of January, the import duty on gold was increased from 4% to 6%. So there was nothing much to do in the budget because already the duty increase had been passed in January.
Mayank, also, how have you seen the physical buying? The kind of declines that we have seen, are people coming back into the markets or are they awaiting further declines?
No, I think the buying has been pretty decent, has been pretty good, and though people expect lower prices to come in, but at these levels the buying has been pretty good because the prices had reached 33,000 at one level and they've now fallen to 29,500, which is a big correction. So the people who are on the sidelines are coming back to buy again.
Buying between gold and silver, where do you see a better demand coming in as far as the physical markets go?
The gold, we are seeing a better demand coming in. Silver, probably people are waiting for 50,000 for the prices to come in.
Also, Mayank, what's your view when the CTT does come in effect from 1st of April? Do you see the futures trading of gold or bullion also declining?
Yeah, I think that will have a very negative impact. That's a representation which we had given to the government also not to put a CTT, because what it does, it dissuades genuine hedgers to hedge in the market. So if we have small mini jewelers and artisans who trade on the MCX platform, and with the CTT coming in, the cost of hedging and the cost of hedging it on the exchange becomes very high. So it's a very dampener which will really thin down the volumes in the commodity exchanges, and it will just shift the trade from the commodity exchanges to the illegal dabba trading or to the international markets.
Mayank, also let's get in a view from you then for slightly medium term to long term on gold and silver prices. What's your expectation given the movement in rupee and the international markets as well? Where do you see the gold and silver prices?
I think gold is headed for a correction with the US looking more brighter and the fear subsiding down. Gold is headed lower in the near term, or probably near to medium term. But for the medium to long term view, we are still bullish on gold. So you should see the prices scaling back to the 34,000 levels, which we saw around 6 months back.
Would you say the same for silver?
Yeah, for silver also we are expecting the prices to a correction to 50,000 and then rebounding back and coming back to 60,000 levels.
Mayank, thank you so much for joining us. I appreciate your time. So near to medium term, slightly on the weaker side, but longer term, you might see gold prices coming back onto those highs. Mr. Bose, let's talk about the crude prices as well then, and that one is trading at around 2-month lows. 110 is where we are trading in sense of Brent crude prices. How are you looking at that trade?
Well, in Brent crude, there's a correction as the geopolitical situation has, I wouldn't say stabilized, but it's moved off the burner. I think the problems with Italy and the problems of growth in China, they've highlighted the demand factor, the demand growth sputtering, as you mentioned. Secondly, winter is over, we're moving into summertime, and stocks are very good. So I'm not surprised the prices are correcting. Especially in WTI, where three things have happened: the configuration of the various pipelines into southern United States, the shale oil and the Canadian tar sands based oil moving through these pipelines, and the third thing is, if you've noticed or heard about, this week there was a flash crash, and one day for a few minutes almost the WTI stopped trading, the ticker stopped moving, and these things suggest that there is a big hedge fund move, perhaps a hedge fund liquidation. And we've seen these things before. Some time back there was a particular week when I think crude oil dropped by $10, if you recall. I don't remember exactly which month, but I think that was last year. And by similar token, some kind of realignment is going on in the hedge fund world, which is causing the WTI move down. Not so much for Brent, but I think European situation is once again moving back to center stage, and those problems are weighing on the market.
Well, that's the view on the crude prices. But Vijay, how do you look at the base metals? And with nickel down, you're trading at around 3-month lows. We've seen all the base metals now turn negative for 2013.
Exactly along expectations, Manisha. This is another area where I've been advocating a hands-off approach on long positions, because even when we were getting positive data on China, we were getting kind of optimistic data emanating from the US markets. None of these base metals were exhibiting signs of moving past their previous significant swing highs or their delta highs, as we call them, with good volumes and open interest expansion. Sure enough, there was a brief period when there was a promise of copper breaking out along with nickel and zinc and lead showing signs of taking second place behind copper. But that period turned out to be more of a false rally which flattered to deceive the bulls rather than see any kind of follow-up buying coming in. I would not really be surprised to see either sideways consolidation with a negative bias or even a few percentage point decline from where we are currently across the board in the base metals pack. There might be varying degrees of declines depending on the beta and the inherent fundamentals of each and every base metal. But my guess is uniformly I would basically expect some more declines to come in before stronger hands come out and lend support and buy. No sign of accumulation is being seen on the charts, and I would agree with Mr. Bose. There does seem to be a small indication of some hedge fund unwinding. There is clearly very strong hands deleveraging in the market here.